Key asset liability management tools used by banks for risk assessment. In the world of banking, managing risks is critical to maintaining financial stability and ensuring sustainable growth. One of the principal frameworks banks use for this purpose is Asset Liability Management, or ALM. Today, we'll explore the key tools that banks employ for effective risk assessment in asset liability management. Understanding Asset Liability Management, ALM. First, let's break down the concept of asset liability management. ALM is a comprehensive approach utilized by banks to manage risks that arise from mismatches between assets and liabilities. These mismatches can lead to liquidity and interest rate risks. So how do banks assess and manage these risks? Let's delve into the key tools. Gap analysis. The first tool in our toolkit is gap analysis. This method focuses on analyzing the timing differences between the cash flows of assets and liabilities. A bank will categorize its assets and liabilities by their maturity terms to create a gap report. How does it work? By identifying periods where liabilities exceed assets, banks can anticipate potential cash flow shortfalls. Conversely, if assets significantly outshine liabilities in the short term, the bank may need to reevaluate its investment strategies. Duration analysis. Next up is duration analysis, which measures the sensitivity of an asset or liability's price to changes in interest rates. This method allows banks to understand the impact of interest rate fluctuations on their balance sheets. Why is this important? If a bank has a greater duration of its assets than liabilities, an increase in interest rates could negatively impact the bank's earnings, as the liabilities will reprice faster than the assets. By managing duration, banks can mitigate interest rate risks effectively. Stress testing. Stress testing is a vital tool used by banks to assess how they might perform under extreme economic conditions. This involves simulating various adverse scenarios, such as significant interest rate hikes or severe economic downturns. What do banks gain from this? Stress tests help identify vulnerabilities in the bank's financial structure and ensure they have adequate capital reserves to withstand financial shocks. Regulators often require banks to conduct regular stress tests, amplifying their importance in risk assessment. Economic value of equity, EVE. Another key tool is the economic value of equity, or EVE. This technique measures the long-term impact of interest rate changes on a bank's economic value. It calculates the present value of a bank's assets minus the present value of its liabilities. Why use EVE? Understanding EVE helps banks assess how their economic value can change with varying interest rates, assisting them in making informed decisions about investment and financing. Liquidity risk management tools. Liquidity risk management involves ensuring that a bank has enough liquid assets to meet its short-term obligations. Tools such as liquidity coverage ratio, LCR, and net stable funding ratio, NSFR, are employed. What do these ratios indicate? The LCR measures the bank's ability to withstand short-term liquidity disruptions, while the NSFR assesses the sustainability of funding over a longer time horizon. Using these tools, banks can manage their liquidity risk proactively. Advanced software solutions. Lastly, as technology evolves, many banks are adopting advanced software solutions for ALM and risk assessment. These tools provide real-time data analytics, modeling capabilities, and scenario analysis, enabling banks to make quicker and more informed decisions. How do these software solutions help? They streamline the risk management process, allowing for a comprehensive overview of financial health and facilitating more precise forecasting and reporting. Conclusion. In summary, effective asset liability management is fundamental for banks to navigate the complexities of financial risks. By utilizing tools like gap analysis, duration analysis, stress testing, economic value of equity, liquidity risk management tools, and advanced software solutions, banks can enhance their risk assessment capabilities and ensure long-term stability. By understanding these key tools, financial professionals can better appreciate how banks address the intricate balance between assets and liabilities to mitigate risks. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.